There is a number that was quietly deducted from your Social Security check every single month this year. It is $202.90. That is the standard Medicare Part B premium for 2026, the monthly charge for outpatient coverage, doctor's visits, lab work, and preventive care. For most people over 65, it comes out automatically before the deposit ever hits the bank. You may not even look at it anymore. It is just the number that shrinks the Social Security payment. Here is what federal auditors and a bipartisan Senate committee confirmed in March 2026, that $202.90 is higher than it should be, not because of inflation, not because of increased healthcare costs, because private insurance companies running Medicare Advantage plans were overpaid by an estimated $84 billion in 2025. And the way Medicare's premium structure is designed, that overpayment got passed directly into the monthly premiums that every Medicare beneficiary pays, whether they are in a Medicare Advantage plan or not. The Senate Joint Economic Committee published an issue brief this year, calculating that Medicare Advantage overpayments increased Part B premiums by $212 per enrollee in 2025, for a combined total of $13.4 billion in additional premiums nationwide. And because roughly 70% of Medicare beneficiaries have their Part B premiums deducted directly from Social Security, that $212 per year, or about $17.70 per month, was coming off the top of Social Security checks without most people understanding why. But that is only the first Part B overbilling problem I want to tell you about today. There is a second one, and this one affects a specific group of seniors directly and has a specific form attached to it that can get money back. So stay with me through both, because the second one is where the actionable step lives. Before we get into it, I want to hear from you. Has your Medicare Part B premium ever surprised you? Either because it jumped unexpectedly or because it was higher than what your friends are paying? Drop it in the comments. The reasons for that gap are exactly what this video covers. And before anything else, everything I share here is educational, not personalized financial advice. For help with your specific situation, contact your SHIP office, which is free in every state. With that said, let us get into it. My name is Walter Barron. I am a state bar licensed estate attorney, and for more than 15 years, I have worked with families on Medicare billing, premium appeals, and the charges that come out of Social Security before anyone explains them. Let us get into it. Let me start with the structural problem, because understanding it changes how you think about the premium you pay every month and why it has been climbing faster than most people expected. Medicare Part B is financed through what is called the Supplementary Medical Insurance Trust Fund. By law, the premiums that beneficiaries pay are set to cover approximately 25% of the program's total projected costs for the year. The federal government covers the remaining 75% out of general tax revenues. That financing structure means something specific and important. If total Part B spending goes up for any reason, premiums go up, not by a small adjustment at the margins, but by a direct mathematical calculation that forces 25 cents of every new dollar of spending onto beneficiaries. There is no discretion in this. It is how the premium formula is written into law. Medicare Advantage plans, the private insurance programs that more than half of Medicare beneficiaries now use, are paid through Part B. The original intent was that these private plans would deliver Medicare more efficiently and at lower cost. According to the Senate Joint Economic Committee's analysis, published in March 2026 and based on data from the nonpartisan Medicare Payment Advisory Commission, those plans have not delivered on that intent. In 2025, the estimated excess was between $76 billion and $84 billion. The government was paying Medicare Advantage plans an average of 120% of what the same coverage would have cost in traditional Medicare, meaning every beneficiary in a Medicare Advantage plan costs the program about 20% more than if that person had stayed in original Medicare. That excess payment flows through the Part B financing structure and increases premiums for everyone, including the beneficiaries who are not in Medicare Advantage at all. The Senate JEC estimated that in 2025, this pass-through effect increased Part B premiums by $212 per person, adding up to $13.4 billion in additional premiums paid by Medicare beneficiaries nationwide. Traditional Medicare enrollees, people not in Medicare Advantage, not receiving the supplemental benefits those plans offer, bore roughly $6 billion of that burden. They paid more without receiving anything additional for it. The Part B premium went from $185 per month in 2025 to $202.90 in 2026, a nearly 10% increase in a single year. The JEC's analysis attributes a meaningful portion of that increase to the Medicare Advantage overpayment pass-through. And the projections looking forward are significant. If current payment patterns continue, Part B premiums are projected to roughly double by 2035, growing from approximately $2,440 per year today to around $5,000. Of that projected increase, the JEC estimates $450 per person would be attributable to continued Medicare Advantage overpayments, money that would come off the top of Social Security checks every month for the next decade. Because roughly 70% of Medicare beneficiaries have their Part B premiums withheld automatically from Social Security, every dollar of premium increase is a dollar less arriving in the bank. The $17.90 monthly increase from 2025 to 2026 eroded approximately 1/3 of the average Social Security cost of living adjustment for 2026. The premium increase and the COLA increase work in opposite directions, and the premium increase has been winning that race for years. There is no form you can file to get the structural pass-through difference back. That premium inflation is a policy problem at the federal level, not an individual billing error with a refund mechanism. But I want you to understand it clearly because it is the context for the second problem, and that one does have a form. The second problem affects a specific category of seniors, people who retired recently or who experienced a significant drop in income in the last few years, and whose Medicare Part B premium is being calculated based on income that no longer reflects their current financial situation. This is called IRMAA, the Income-Related Monthly Adjustment Amount. It is a surcharge added to the standard Part B premium for people whose modified adjusted gross income exceeds certain thresholds. In 2026, the surcharge begins for single filers whose MAGI exceeded $106,000 in 2024, and for married couples filing jointly whose MAGI exceeded $212,000. The surcharge tiers go up from there. At the maximum tier, the IRMAA adds $5,844 per year to Part B premiums alone. Add the Part D drug plan surcharge on top, and the maximum combined IRMAA surcharge for 2026 reaches $6,936 per year. That is nearly $578 per month in additional Medicare premiums, on top of the standard $202.90. Here is the specific problem that creates overbilling. IRMAA is calculated using your income from 2 years ago. In 2026, Social Security uses your 2024 tax return, not your current income, not your 2025 earnings, your income from 2024, which, for someone who retired last year or the year before, may have been a full working salary that pushed them into a higher premium tier. For someone who earned $130,000 in 2024 and retired in mid-2024, their 2026 Part B premium is being calculated as if they still earn $130,000, because that is what the 2024 tax return shows. But their actual 2026 income might be $30,000 in Social Security and a modest pension. They are paying a premium that belongs to a tax bracket they left, and Social Security has no automatic mechanism to catch this. The surcharge stays in place, deducted from every Social Security check until someone files a form specifically asking for a correction. That form exists. It is Form SA-44, officially titled Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. It is available as a free PDF at ssa.gov. You file it when you have experienced a qualifying life event that has permanently reduced your income to a level that would place you in a lower IRMAA bracket or eliminate the surcharge entirely. The qualifying events are more numerous than most people know. Retirement itself is a qualifying life event. So is the death of a spouse, divorce, loss of income-producing property, such as a rental home, reduction in or loss of pension income, work stoppage or work reduction due to a medical condition. If any of those events happen to you or your spouse in 2024 or 2025, and your current income is materially lower than the 2024 tax return that Social Security is using to set your 2026 premium, Form SSA-44 is the tool for correcting it. When the SSA accepts the appeal and adjusts your premium, the adjustment is retroactive to the month of the qualifying event. If you retired in July 2024 and have been paying a surcharge based on your full 2024 working income since you first enrolled in Medicare, and your appeal is approved, the excess premiums are credited against your future Part B bills, typically applied as a reduction in what is withheld from upcoming Social Security checks. In published accounts of IRMAA appeals, beneficiaries who filed SSA-44 after retirement have received credits of several hundred to over $1,000 applied to their upcoming premiums. The correction is not paid as a separate refund check. It comes as reduced withholding in the months following approval. The processing time for SSA-44 appeals is typically 30 to 90 days. If the initial appeal is denied, you have 60 days to request a formal reconsideration. Beyond that, the appeals process escalates to an administrative law judge hearing and further levels if necessary. The success rate at the administrative law judge level for valid claims denied due to administrative errors runs in the 40 to 50% range, according to advisors who work with Medicare beneficiaries on premium appeals. Valid claims with proper documentation, clear evidence of the qualifying event and current income tend to succeed at the initial or reconsideration level without needing to reach an ALJ. There is a third scenario worth raising separately because it catches people every year and it does not require a qualifying life event to fix. Incorrect tax data. Sometimes the IRMAA surcharge is wrong, not because your income dropped, but because the IRS gave Social Security the wrong income figure in the first place. This can happen when you filed an amended tax return and the IRS transmitted the original return to SSA rather than the corrected version. It can also happen through clerical errors in how data is transferred between agencies during annual processing. The result is a Part B premium based on an income that does not match your actual tax record, and Social Security has no system that flags this discrepancy automatically. If you filed an amended return for 2024 and your Part B premium for 2026 appears to reflect the higher income from the original filing rather than the lower income from the amendment, the fastest path to correction is a call to Social Security at 1-800-772-1213. Tell them you filed an amended return for the tax year they are using to calculate your IRMAA, and that the income figure SSA is using does not reflect the amended return. They can initiate a correction request with the IRS on your behalf. You can also submit Form SSA-44 in this situation, attaching a copy of the amended return and documentation showing the corrected income figure. The form is designed for life-changing events, but it serves as the written mechanism for any IRMAA correction, regardless of the cause. The key piece of information most people miss about all three of these situations is timing. There is no strict deadline that permanently closes your right to file an IRMAA appeal, but every month you delay is another month of the higher premium deducted from your Social Security check. And the retroactive correction, when it comes, covers months from the qualifying event forward, not months you failed to flag for review. Filing promptly is always in your financial interest, and the earliest date of the qualifying event is the earliest date from which the credit can be applied. Let me leave you with the 3 actions that follow from everything I just covered, because the problem is only useful to know about if it leads to something you can actually do. The first action is to pull up your current Medicare Part B premium and compare it to the standard rate of $202.90 for 2026. You can find your current Part B premium on your Social Security benefit statement, either the paper statement mailed to you or the digital version at ssa.gov, or by logging into mymedicare.gov. If your premium is higher than $202.90, you are paying an IRMAA surcharge. Write down exactly how much more you are paying and what tier that places you in. The 2026 IRMAA tiers are published at ssa.gov. Then ask yourself, was my 2024 modified adjusted gross income genuinely above the $106,000 threshold for single filers, or $212,000 for married joint filers on a sustained basis? If yes, and your income has not changed materially, the surcharge is working as designed. But if you retired in 2024 or 2025, or experienced any of the other qualifying events, the surcharge you are paying may be based on income you no longer have. The second action, if you believe a correction is warranted, is to download Form SSA-44 from ssa.gov/forms/ssa44.pdf. The form asks you to identify the qualifying life event, estimate your current year's income or provide documentation of the corrected amount, and attach supporting evidence. For retirement, that typically means a letter from your former employer confirming your retirement date and a current income estimate showing what you are actually receiving in 2026. For a spouse's death, it means the death certificate and current income documentation. Once you submit the form, by mail to your local Social Security office or in person at an SSA field office, appeals typically take 30 to 90 days. If approved, the reduction in your Part B premium is applied retroactively to the month of the qualifying event, credited against future Social Security withholdings rather than paid as a separate check. File as soon as you believe you qualify. Every month of delay is another month of the higher premium deducted without correction. The third action is to use this information at your next Medicare open enrollment period. The structural overpayment problem, the $84 billion pass-through that inflated everyone's Part B premium in 2025, is not something you can appeal, but it is relevant to how you evaluate Medicare Advantage plans going forward. If a Medicare Advantage plan offers you supplemental benefits like dental or vision coverage, the question to ask is whether those benefits genuinely offset the structural premium costs embedded in the program that are driving your Part B rate up year after year. Your SHIP office can help you run that comparison at no cost, and they can also help you determine whether Form SSA-44 applies to your situation before you file it. That single free call can clarify both questions and save you the effort of filing a form that does not apply to you, or failing to file one that does. If you know someone who retired in the last 2 years and has never questioned why their Part B premium is as high as it is, please share this with them. The form takes about 20 minutes to complete. The savings it can produce, retroactive credits applied to future Social Security deductions, can be real and meaningful. And the premium increase driving it is documented in a bipartisan Senate report that is publicly available for anyone to read. Thank you for watching.